Good afternoon, Jay Brown here at Cornerstone Financial Management, Certified Financial Planner. Today is July 17th. We hope you had a great 4th of July and that weekend and your summer's going great so far. Just wanted to give you a quick update on a couple of things. So first of all, we're not doing a market update today. We've got another market update scheduled for the future, and so we're going to be getting into that in our next video. And also, there's going to be some additional videos to come about the One Big Beautiful Bill Act that was recently passed. I believe it was signed into law on July 4th. Some of the key bullet points with the bill and the impact that that could have on your specific financial situation. So at least one, maybe multiple videos in the future regarding that bill. After our last video that Ken did on Roth conversions, we've had some additional questions on some financial planning topics, and so I chose 3 to cover today. And one thing that I'll mention, this is not intended to be specific advice for your situation. We want to give more general information about financial planning topics. If you have any questions specific to anything that we talk about and you want us to dive into your situation, let us know and we certainly can. But the first question that we're going to tackle today is, how much cash do I need in my bank account? How much cash do I need in my bank account? And this is going to be a little bit dependent upon the situation, but our general answer is 3 to 6 months worth of expenses in a bank account. Now, typically what that's going to look like is we're going to have a checking account that's going to have a $5,000 to $10,000 buffer. And that's where your income comes in, your bills are being paid, your gas, your groceries, all of your cash flow is coming in and out of that checking account. Then we have a high yield savings account that we have our 3 to 6 months worth of expenses. The idea being that, if something were to happen in an employment situation or, a roof situation, or there was a significant expense, we could take money from that emergency fund to cover the necessities for that period of time. Now, the landing spot for that savings account, typically you want it to be a high yielding savings account, whether that's at your traditional bank, a credit union, an online bank. That's up to you, and we can certainly provide some information on, what may fit your situation. But that would be the idea there, 3 to 6 months worth of expenses. And typically for our clients who are dual income households, and those incomes are believed to be consistent or pretty standard, monthly incomes, 3 months is a pretty safe spot for most people. For our, commission-based or maybe single income households, we tend to look more toward that 6 months worth of expenses when it comes to the cash that you need to have on hand in your checking and then in your savings and emergency fund. And so that's one question we get a lot. Beyond that, 3 to 6 months, that's when we start getting into the conversation of retirement funding or education planning, paying off the house. There's some more variations of what the next step is after that emergency fund. The second question that I wanted to dive into a little bit today is a question, it kind of parallels with the IRA conversation from last week, but it's, what is a qualified charitable distribution, also known as a QCD? Some people have probably heard that, others maybe not. And so what I wanted to touch on today was a couple of bullet points about the QCD. What it is it's a direct transfer of funds from a pre-tax IRA to a qualified charity, to a 501c3. Church, foundation, anything that has that 501c3 designation. Now, a couple of things that make the qualified charitable distribution a QCD is that the account owner must be 70 and a half years old. So if you've hit that criteria, you have a pre-tax IRA account, you're 70 and a half years old. You can then take the funds directly from your IRA and transfer them to the charity without taking a withdrawal, and that satisfies, or it can satisfy all or some of your required minimum distribution that the IRS requires you take out of that fund, and you don't have to pay taxes on that withdrawal. So for example, if you have to take out $10,000 as an RMD this year, you could take that $10,000 out, pay taxes on $10,000, and then it's sitting in your bank account. Or you could send that $10,000 from the IRA directly toward your church, directly toward some sort of foundation or charity. You don't actually pay the taxes on that $10,000 worth of income, and it satisfies the RMD. Now, you don't get a tax deduction for that charitable contribution because you're not having an income from that. So you don't get the tax deduction for the charitable contribution. However, you don't have to pay taxes on that $10,000 in this situation as an RMD. Again, only traditional or pre-tax IRAs are eligible. You can't do this with your 401k or an employer plan, an active employer plan like a simple IRA or a SEP IRA. The recipient of the QCD must be a 501c3 charity. You will get a 1099-R form next year for this year's QCD, and so your tax preparer, your accountant will be able to handle that accordingly. But it is an option. Where it's an option is for some of our clients or for our IRA account owners that have to take an RMD, but may not necessarily need that as income, and they don't want to take on a larger chunk of income taxes. Now there is, the final detail that I'll give with the QCD, at least generally speaking, is there is a maximum. The maximum that you are allowed to give from an IRA to a charity per year is $108,000. That's the maximum. And so for a married filing joint couple, the maximum in 2025 is $216,000 can come from an IRA to a charity. And so that's a QCD in a nutshell. It's something that we do with some of our clients and can certainly have those conversations if you're over 70 and a half and do have some pre-tax IRAs that we want to maybe consider engaging in that qualified charitable distribution strategy. The final topic that I'm going to touch on today is going to be what's called the backdoor Roth. Some of you have maybe heard of the backdoor Roth, what it is, what does it mean? And again, I'll give a few bullet points here on what the backdoor Roth is. Before we kind of get under the hood, I will, similar to the QCD, identify who it may pertain to. And so in a backdoor Roth situation, really, we're looking at high income earners. You know, if married filing jointly, couples are making above, and I think in 2025 that number is a little bit over $250,000 of taxable income, then this backdoor Roth situation may be ideal for you because, you know, the IRS sets the limits for what the modified adjusted gross income number is in order to qualify to put money into your Roth IRA. If you're above that number as established by the IRS, this could be a strategy for you. Additionally, if you do not have a traditional IRA, a simple IRA, a SEP IRA, or a rollover IRA, this strategy could be in play for you. If you have one of those, then it may be something that we want to look at before we do the backdoor Roth. But what it is, an account owner would make a non-deductible IRA contribution. You can do up to $7,000 in 2025. If you're over $50, $8,000. But you put a non-deductible money into an IRA, so that's after-tax money, and then you immediately convert that to a Roth IRA. That's the backdoor conversion that we talk about. And so, you know, that $7,000, you don't get a deduction, you immediately convert it to Roth IRA, and then, like Ken talked about last time, in that Roth IRA, that money would grow tax-free really indefinitely as long as you take that money out after 59 and a half. Now we've covered backdoor Roths, we've covered a few other questions that we've had recently, and if you have any questions or any topics that you'd like us to cover in a video, we'd love to hear from you, and that might be an opportunity to get your questions answered in a video. So please let us know. We hope you're having a great summer. As always, if you need anything, please don't hesitate to reach out.